introductions on our side. We have the pleasure of being joined by Mr. Ajay Piramal, the chairman of Piramal Group. And while he needs no introduction, suffice to say that he has been the driving force behind the group's rise across pharmaceuticals, financial services, and real estate businesses. He's regarded as torchbearer for responsible entrepreneurship, with a strong focus on creating long-term value for the group's stakeholders, as well as the community as a whole. We also have with us Ms. Nandini Piramal, who is the chairperson of Piramal Pharma, and also leads the OTC business of the company. We have Mr. Peter DeYoung. He is the CEO of Piramal Global Pharma and a member of the Piramal Pharma board. In his current role, he is responsible for steering strategy and driving profitable growth of these businesses. Prior to this, he has worked with organizations such as McKinsey and Blackstone across various roles. We have Mr. John Fowler, who is the Chief Operating Officer of the CDMO business, with responsibility for operations and R&D across all PPS sites in North America, Europe, and Asia. Prior to this, Mr. Fowler has served as a divisional CEO at Johnson Matthey. We have Mr. Stuart Needleman, who is the Chief Commercial Officer of the CDMO business. He's responsible for driving all global business development activities for the services business, ranging from discovery to commercial supply. Prior to this, he has worked in key roles at Loris Synthesis and Aptuit, among others. We also have Mr. Michael Logerfo, who is the President and Chief Operating Officer of the Complex Hospital Generics business. Michael is responsible for sales, marketing, R&D, manufacturing, supply chain, business development, and quality roles. Prior to joining Piramal, Michael was a senior leader and president at Sagen Pharmaceuticals. Mr. Nitish Bajaj, who is the CEO of the consumer healthcare business of Piramal Pharma. He brings with himself an extensive experience and knowledge in business and marketing strategy in the consumer healthcare business. We also have with us Mr. Vivek Valsaraj, who's the President and CFO at Piramal Enterprises Limited, and Mr. Hitesh Tata, the Chief Investor Relations Officer at Piramal Enterprises Limited. In terms of agenda for the discussion today, we will start with the overview and evolution of the pharma business of Piramal Group, along with the recent capital raise, which will be covered by Mr. Ajay Piramal. This will be followed by a discussion on the key highlights of the company by Ms. Nandini Piramal and Mr. Peter DeYoung. We expect these two topics to get covered in approximately the first hour. And following this, there will be individual presentations on the key business segments for the next hour. We will open the floor for Q&A for the last 30 minutes of this interaction, and will request participants to share their questions with us on the email ID that will be displayed on the screen for coordination purposes. With this, I will hand over the presentation to Mr. Ajay Piramal. Over to you, sir.
Thank you, Dhiresh. Good afternoon, and welcome to our Pharma Day. Thank you for taking part. We believe that values create economic value, and our values are the common thread binding people across a diverse set of businesses, geographies, and functions. Our corporate purpose of doing well and doing good is embodied in our continuous endeavor to make a positive impact by serving people and living our values. For more than 3 decades, we have taken several bold initiatives to consistently transform and evolve our company. As part of these multiple rounds of transformation, we have successfully entered new markets, expanded our capabilities, and made significant investments and efficiently allocated capital. Our first phase of transformation was in 1988. We exited the textile business and entered the pharma business. Through a series of M&As, JVs and alliances, and various organic initiatives, we rose from being the 48th company in the Indian market in 1988 to become the 3rd largest domestic formulations company in 2010. Our second phase of transformation was when we sold the domestic formulations business in 2010 to Abbott. We got a value of 3.8 billion, which was 9 times of turnover and at a 29 times of EBITDA multiple. This has been the most valuable transaction in a domestic formulations business anywhere in the world, even till now. After this, we rebuilt a pharma business and scaled it all the way back to a value of 3 billion. That is a business that we will be talking to you about later. We've created a differentiated financial services business at scale. For us, M&A has been a force multiplier in our journey. As we continue to live by our values and continuously evolve our business model, we have been able to create significant value for all our stakeholders. Over the last 32 years, the company has delivered a revenue CAGR of 23%, a net profit CAGR of 28%, and annualized share returns of 25%. We are now in phase 3 of our transformation journey and transforming our pharma business into a large, differentiated, listed pharma company, thereby moving from a multi-sector conglomerate structure into focused listed entities within pharma and financial services sectors. We have taken several steps towards creating 2 separate listed entities. During the last 1 year, we have been, first of all, simplifying the structure by selling less strategic businesses and bringing similar businesses together. We simplified the structure with the sale of DRG. We've sold our investments in Shriram Transport and have made a commitment to monetize the other investments in the Shriram Group at the appropriate time. We brought all the pharma businesses under one subsidiary called Piramal Pharma Limited. The second step we've done is to strengthen the balance sheets of both the businesses, the pharma as well as the financial services business, so that they can stand independently in the future. We strengthened our pharma balance sheet with fresh equity infusion for future growth and strengthened our financial services businesses through multiple capital raise initiatives. A further step in this direction has been to have separate boards and management teams for both the businesses. And we now have their own independent directors as well as executive directors. Both businesses have separate top quality management teams. And we are now getting future ready. Pharma business has started investing post the capital raise through organic and inorganic initiatives. Through the organic build-up in the financial services business and DHFL acquisition, the model will be more diversified, resilient, and future ready. With all these initiatives, we've already become much simpler and stronger and continue to make progress towards creating 2 large entities in the financial services and pharma sector. Post sale of the domestic formulations business to Abbott, we've rationalized our pharma business portfolio and focused on 3 core pharma verticals with a long runway to growth: CDMO, complex hospital generics, and the India consumer healthcare business. In late 2019, we embarked on a search for a like-minded investing partner for strategic growth capital in pharma. This was also a step in the direction towards the eventual demerger and separate listing of our pharma and the financial services business. Accordingly, all our pharma businesses have been integrated under one subsidiary of PL. In June 2020, Carlyle Group agreed to invest fresh equity capital of up to $560 million for a 20% stake in Piramal Pharma Limited, making it one of the largest PE deals in the India pharma sector. What gives me great satisfaction is that this whole investment was done at a time of COVID without any physical visit to any of our plants in this country. And yet, I think because of the high values that our group has and the credibility, Carlyle agreed to invest in this business. The deal was valued at an EV of $2.8 billion with an upside component of up to $360 million. These funds will help strengthen our balance sheet and accelerate organic and inorganic growth plans. In the third quarter of FY21, we received 3,500 crores on closure of the strategic growth investment by the Carlyle Group. We look forward to leveraging Carlyle's deep expertise and global strengths to bolster our growth plans. Since the beginning of the previous financial year, the company has brought in 18,000 crores of capital versus our initial commitment of anywhere between 8 to 10,000 crores. This includes multiple steps that have significantly strengthened and deleveraged our balance sheet. Today, the equity for PEL stands at 35,467 crores. Our net debt to equity at the overall PEL has reduced to below 0.9 versus 2 in September 2018. The Carlyle capital raise has significantly deleveraged the pharma balance sheet, positioning the business for future organic and inorganic opportunities. Our net debt to equity for the pharma business stands at 0.5 times post the fundraise versus 0.9 times as of March 2020. Net debt to EBITDA of 2 post fundraise versus 2.8 as of March 2020. It gives us great satisfaction to say that the pharma business has benefited from a superior leadership team, from our strong, active, and independent board members to our experienced and globally distributed senior management team, some of whom you will see today. Moreover, to deliver on our strategic priorities, we have consistently invested in key talent who are valuable contributors to our success. Nandini will be elaborating on this further later in this discussion. Pharma is one of the safest and most resilient industries in the period of uncertainty, and the last year has only proved this. The recent strategic growth investment by the Carlyle Group is an affirmation of the underlying strength of the business and it will provide us with a war chest for the next phase of our strategy. With our next transformation, we would make further progress towards our stated objective of demerging the financial services and pharma businesses. We have clearly defined roadmaps in place for both businesses, and I'm confident that both these businesses will emerge as two strong companies with a good runway for growth in the long term. Nandini and Peter, along with the pharma leadership team, will be talking about the performance of Piramal Pharma and the strategic roadmap in more detail. Thank you.
Thank you, everyone, for spending time with us. We'll talk a little bit more about what has happened in the last decade for the pharma business. We've grown our revenues to 5,419 crores for FY20, which has seen a 15% revenue CAGR and a 33% EBITDA CAGR. We're now in more than 100 countries where we have a commercial presence, and 14 development and manufacturing sites across North America, Europe, and India, which make us a truly global player. Since the last transaction with Abbott, we've executed 15 acquisitions and integrated them into our network. And lastly, which I'm also most proud about, is we have 5,200 employees, each of us who helped us have no official action indicated issues with the FDA in the last decade. So we're going to talk a little bit about what's going to happen next. Each of the pharma businesses are targeting large and attractive markets with high entry barriers, and each of them are in a strong position in the respective market segments. One of the things they have in common is our quality track record, which spreads across all of the businesses and has seen audits by various regulators and customers and with no issues. Our patient and customer centricity organization helps us actually win business and differentiate our competitive positioning across the businesses. We have a global leadership team without which we couldn't actually execute on our strategy of doing both organic and inorganic growth. All of this has helped us create a diversified presence across regions, capabilities, and customer categories, which has helped us establish our very strong financial performance. I'm going to hand over to Peter, who will talk a little bit more about each of the businesses.
Thank you, Nandini. The first decision we need to make in pharma is which markets we want to compete in. And as Mr. Piramal mentioned in his section, one of the first choices we made was to narrow down to these 4 markets because we found them to be particularly attractive, and we saw a long period of runway of profitable growth for us in each of them. So now I'm going to step through each of them sequentially. The CDMO market is large, $55 to $70 billion in size. It's growing because the underlying pharma market is growing, and the desire of pharma players to outsource is continuing or growing. Within that, there are certain areas that are more attractive and growing faster, and also where supply is more limited. And that includes areas such as antibody drug conjugation, high potent APIs, and sterile injectables, to name a few. In addition, this industry is hard for customers to change. Ultimately, once a customer picks a particular CDMO partner for a particular activity, it's that partner's business to lose because of the amount of time, energy, and cost required to make that change. In addition, customers are looking for any provider who can help them get their product to the next inflection point, whether it be a clinical trial result or a commercial launch. And that's a very important factor in choosing. And a final point is that this is a highly fragmented market with no clear dominant players and a significant long tail of smaller players. The next market is the complex hospital generics market, which is once again more than $50 billion in size. And there are fewer players in this area of generics than other areas of generics. And also for those players, for any given product, there are fewer people making that product in a given country than other generic products. And that's really driven due to the complexity and difficulties in making these products. And ultimately, that results in allowing for better pricing environments than traditional generics. And in addition, the channel and how you sell to this is different, which is allowing a more distinct and different approach, including longer-term contracts. I'm sure many of you are familiar with the Indian consumer story and how, as India is growing and its young population is becoming more aspirational in its needs and wants, there are unmet and increasingly needing to be met needs around consumer healthcare. And this is an attractive growing market that we also believe has a lot of runway for further growth. That's been additionally turbocharged with the, even pre-COVID, but accelerated during COVID, transition and emergence of e-commerce as a viable channel for distributing and selling and even launching products. And finally, on an additional related point, the ophthalmology market in India is also quite large and growing, and also following the larger India pharma story. So in sum, all four of these markets are large, attractive, and growing, and we do expect them to give a long runway for profitable growth if you have a good position and a right to win. So that leads us to the next question. In each of these four businesses, we also have a strong position. In the CDMO business, we're one of the 13 largest CDMO players globally, and we've grown this business, coincidentally, 13% over the last decade. And within that, we're present across all of the life cycle, from discovery to off-patent commercial and everything in between, and also API or drug substance and formulations or drug product. Next, in the area of complex hospital generics, we are one of the top 4 players in one of the larger categories in this market, which was inhaled anesthesia. And in addition, that business we have grown over the last decade or so, 19% CAGR. And we are also now present through some of our more recent strategies in the areas of injectable anesthesia and pain, injectable intrathecal therapy, and other injectables. And so we have a strong presence and a growing presence in this global market through multiple product categories. In the area of the India consumer healthcare, we are also growing at 14%, and we're almost at the top 10 in that industry at number 11. And we're one of the few players that is straddling both between pharma and consumer goods. And we have a strong portfolio of 21 brands, and I'm sure many of you are familiar with some of them from your youth or even today. And finally, we are the market leader in the ophthalmology market in India through our JV partner, Allergan. If we want to shift, having established this markets are large and attractive and that we have a good position in them, we're now going to discuss some areas of differentiation, or why we think we have a reason to win or succeed in these attractive markets. One of these areas Nandini mentioned earlier is common across all of our businesses, and this is our best-in-class quality track record. As you can see on the left, we have a long time horizon of audits with no adverse outcomes in terms of the OAI measure. And we think that's actually enabled by the chart on the right, which is that we have a significant number of customers who visit one of our locations at any given point in time each year. Practically before COVID, each week we would have a customer walking through one of our facilities. And that forces you to be on your game, because at any given point in time, your facility could be visited, and you have to be sure that you're audit ready at that point in time, and that you can explain to that stakeholder why what you're doing is right for their patient and their quality systems. And that has forced us to really be consistently good. And a second reason why we think we've had these good outcomes is our reporting structure for quality, where it has an independent reporting to a board member. And this allows us to have a chain of communication to make sure that we have outlets to ensure that we bring our best selves each day and do the right thing each day. And if not, there's a way to address it. And those are at least two of the reasons why we think we've been fortunate to have this sort of long-term track record. But there are additional bits behind that. If we had more time, we would love to share with you. The second area of common differentiation across all of our businesses is in the area of patient and customer centricity. As many companies may have started, we initially were a product-centric company. We would make something and then we would look for someone to buy it. And it was very much a manufacturing or product-led approach. The first transformation we did several years ago was to turn that on its head and say we were a customer-centric business. We would first identify who our key customers were and are, and we wanted them to be. We would find out what their needs and wants were, and then we would find out how to serve and become more relevant to them. And that transformation happened across all of our pharma businesses. But then we added an additional lens, which was to understand that in many of these cases, the customer is actually in business to serve patients, and the best way to meet their needs is to understand and align to their needs. And so over the course of the last year, we really did launch and embrace the concept of patient centricity. And what this means is that now we are aligned, and our purpose for being is our customer's purpose for being, and it makes us more relevant to them. This may seem abstract, so let me pick two examples to try and bring this to life. Both of them came to being during the COVID pandemic. As I'm sure the pandemic has gone on longer than all of us would have initially anticipated, if you play back in your mind to late March, early April, at this point in time, the pandemic was still in its earlier stages. We had developed workplace guidelines to address how we would encounter our first COVID case at one of our plants and what we would do. And lo and behold, it did happen at our Riverview facility, which was at the time making a product, an oncology product for a blood cancer drug that was on market and being used by cancer patients around the world and in critical need of resupply. At that time, given the uncertainty around the treatment of these situations, we did have to pause our plant for a period of time, but this particular drug was in critical need of resupply to avoid cancer patients not getting their therapy. And we were able to arrange volunteers to take the right safety precautions to ensure that they were safe, but also we got the product to the patients and that there was no interruption in their supply. And while in this stage, between then and now, many companies and many people have seen many heroic stories, I think this is just one such example in a long line of examples across our locations where our employees understand what they need to do and why they're doing it, and that helps them do it better. The second example would be in the UK in relation to COVID as well, where, as I'm sure you are also aware, in some cases, patients require ventilation support, and that is very painful. And the only way that that can be tolerated is through the use of certain injectable pain medicines, of which we make some of those that we acquired previously from Janssen. We are newer to the market and we were less well known, and these products ran short across the UK and many other markets. And in moments of crisis, we were able to provide additional amounts of those products on short notice, including sometimes redirecting from other areas to ensure that patients there were able to access these important medicines. So much so that when the UK government announced an emergency tender to create a stockpile for future such events this year, we won that for this and other important categories, establishing that when we understood what patients needed and were able to be flexible in how we went about it. So these are just two examples as to how we ultimately do focus on the patient and how it helps us differentiate versus our competition. If we now go on to the next section, which will be the CDMO business. Now we're gonna, in each of these three businesses, we're gonna describe what makes us different. Why do we think we should be able to win more than our competition? The first area is in the areas of, we are a global integrated service provider for both innovative and generic drugs. We cover the entire life cycle. And that's a mouthful, but essentially it means that we can address a wide range of services for a wide range of customers. The second area is that we offer both services on a one-to-one basis for customers, and we offer generic offerings for multiple customers, the same offering. And this can be across drug substance or API, or drug product or formulations. What this allows us to do is that many of our plants, in fact, can make both. And the lead times are such that API services revenues can be very predictable, but they can also be somewhat lumpy in terms of what is needed when. But the generic offerings can often be adjusted to fit within the spare capacity, and ultimately we can keep our plants running at very high levels of utilization through this blended strategy. The third area of differentiation is that, as I mentioned earlier, certain areas of the market are particularly in demand. I would call these magnets. John will later probably use the word hook. These are essentially why people call us, things we do that other people need that not everyone can do, that is of interest and increasing relevance. One area is high potent APIs. A second area is antibody drug conjugates. A third area would be sterile injectables, and in particular within that, containment-oriented sterile injectables. And finally, hormones. These are all very interesting areas that people call us to try and locate how to do it. The next area is around flexible integrated global manufacturing in North America, Europe, and India. We're one of the few CDMOs of this size that has credible capabilities across all three major service delivery geographies of North America, Europe, and Asia. I'm going to give you an example, though, what I mean by flexible. And what it is going to be, I'll give you two. The first one is an oncology company that initially got to know us through one of our facilities, but as their product became bigger and continued to grow, they were worried about having single site reliability issues, and they wanted to go to dual sourcing. Very reasonable request. They were asking, and also they had a little bit of uncertainty as to how much demand they truly would have and how it could be met within our one facility. So in this response, we actually worked out a way where we could pick two facilities in our network in two countries, where we could say, you give us the amount of demand, we'll balance it across our two sites, we'll meet your needs, we'll address your dual sourcing requirement, and we can treat it all within our network, so you don't have to worry about keeping vendor A or vendor B happy. You have partner us, and we'll solve it for you. They really appreciated that and appreciate the flexible attention we gave them. I'll give you a second example of a large MNC customer who we work with across a large number of our sites across multiple geographies. They noticed that they were spending a lot of time on procurement activities for reasonably a lower value single orders, of which there were many in one of our facilities. And after some discussion, we realized that actually, if we could give them standardized, rule-driven pricing, we could allow them to go from idea to action in days or weeks instead of months or quarters, and give them the same value and certainty they expected. And this allowed them to really crunch the amount of time needed to take these actions, to pull up or pull forward or remove CMC or manufacturing from the critical path to their inflection point, which they really valued. And I think the final one is that all of this comes together in terms of allowing us to really be the partner of choice. And I think Stu will cover it later in our presentation, but we see this coming up with our consistently over 50% win rate in proposals and our strong growth in all three categories, but particularly strong growth in emerging biopharma, where these sorts of capabilities are particularly relevant in addition to the other two categories. So these are the areas of the CDMO that we think make us different and interesting and likely to grow faster than our competition. If we go to the next section of complex hospital generics, we are a global complex hospital generics platform. We think that in and of itself is distinctive because there are not that many hospital-focused only companies, and we are one of them. The second is that within that unique focus on this channel and this customer, we have a defensible, differentiated portfolio of products, in particular inhalation anesthesia, but also other ones. Michael will cover later in his presentation some of these barriers to entry, but ultimately how this product is made requires bespoke manufacturing, and how it is used requires dedicated medical equipment in the area where it is used, called a vaporizer. And so ultimately, this allows a certain amount of stickiness. Similarly, our Intrathecal franchise also is used with a particular medical device and requires refills. And so therefore, there is also a certain sticky element to what we do there. And if you march through our entire portfolio, most of it has some aspect to it that even within the already attractive area of complex hospital generics has an additional angle or flavor that makes it more differentiated or have an additional barrier to protect that revenue stream. In addition, we have transitioned to add a pipeline of products that we have developed through third-party means. And this is actually what we think is one of our secret sauces, where we take the best of in terms of products across different sources and plug them into our channel. And it used to be 4 years ago, if we had a new product launch, it was a big deal. We'd have to organize everyone. It was a lot of effort. We'd have lots of meetings. Now, if we get a new product that we sign, we just hand it to our external supply team, our sales team. It runs through our standard processes, our standard IT tools, our standard channel options, and then we hear how it does because it does well. And it's a more routine, scalable action that doesn't require incremental headcount or effort. And that's really the beauty of this platform. And that's really enabled by, in part, the next area, where for the key markets, we have our direct sales capabilities, and in other markets, we have B2B capabilities through partners. And what this really allows us to do is actually have a much wider range of geographies to discuss with potential product providers mentioned earlier, so that we can almost always find a fit if there's a good provider and a good product across our network. And finally, connecting all the dots, we are vertically integrated where it matters and where there are a few alternatives in the area of inhalation anesthesia. And we are using external development and manufacturer partners where we want to take the best of across multiple potential options. And that combination, we think, is somewhat unique in our industry. And that blend allows us just to get both capital efficiency and productivity improvements where it matters, and also have a certain amount of speed and agility that wouldn't be possible if we did everything ourselves. If we shift to the next area of India consumer healthcare, we can describe also what makes this an exciting business where we think we are well positioned. The first is we have a significant number of brands, many of which you would know. And in particular, within that set of brands, we have 5 or 6 that we think are particularly strong. And these power brands, we believe, can grow disproportionately. And I'm sure many of you would remember them from your growing up, as I mentioned earlier. And hopefully some of you have taken some of them, hopefully not all of them. And we think that they have a lot of room to grow. This is coupled with a very strong field force and a lot of reach into India. And we have, along with that, in particular, a new channel that we've developed this muscle more recently. This is the area of e-commerce. I want to spend a minute on this, and I'm sure Nitesh will cover it in even more detail later. We had been working on our e-commerce channel to augment our more traditional channels over the last few years, but this really got put on steroids if you look at in the last year, where many of our other methods of reaching out became more difficult. And we were able to use this channel to reach a number of customers with our existing products, which was great. But we also launched a wide range of new products during the pandemic with record numbers of product launches with incredibly high success rates that allowed us to become relevant in those channels in that category. And then later, we've actually been able to transition that success to the more mainstream areas as well. So we've discovered through iteration and a bit of crisis that this channel is a great place to test out, incubate, and then ultimately succeed with new product launches. And that's a great place, a great new capability we've developed. I'll now transition it to Nandini, where she'll describe all of this strategy only gets you so far unless you have great people, and I'll let her describe a bit of that to you now.
Thank you. I think for all our people, I think we couldn't do what we want to do and what we have done without them. They have more than 200 years of experience cumulatively, and over 90 years of experience with the group. And this has helped us have a proven track record of both organic and inorganic growth. As I mentioned before, we've completed 15 acquisitions in the last decade. And for each of these acquisitions, we've invested organically to grow them as they become part of our network. I'm going to give you a few examples of the acquisitions that we have done. We bought a plant from a company called Ash Stevens, which was a single proprietor facility. They had one BD network, and we plugged it into our global BD network that is connected across the world. That allowed us to increase revenues and increase EBITDA margins. We've now invested more to expand the site and have actually announced a $35 million expansion for more labs and the office as we expand more people. The other benefit of an acquisition such as this is that it allows us to offer integrated projects which link to our other networks, which makes the sites and the customers more sticky. So key customers in this have been served by other sites, including Aurora, Digwal, and Ennore. In another story, we bought the intrathecal therapy from called Gablofin and Mitigo from Mallinckrodt. And since then, we've managed to increase our EBITDA margins while integrating it into our national accounts team and increase the uptake with large consumer accounts. Our Little's baby care brand has also seen very, very good growth this year. We've used e-commerce successfully to launch and to maintain a leadership position in baby wipes and feeding bottles, and have now just launched diapers and are looking for a whole master brand concept to increase sales for this. So all of this has led to us having a very diversified model with global capabilities with a focus on regulated markets. We have 14 manufacturing and development facilities, and which are the key ones are US FDA inspected. We are now also very, very diversified across regions, capabilities, and customer categories. So for whichever metric and segment that you want to look at, we have a diversified play there. And I think that has helped us have a consistent long-term track record of revenue growth. So we've had, for the last decade, a 15% revenue CAGR, and that's an organic CAGR that we expect to maintain going forward as we have built the foundations and the organic investments come online. Acquisitions that we plan to do will continue to add onto this and will continue to improve EBITDA margins. So we've seen a significant improvement in EBITDA margins over the last few years, and we expect that in the long term, we will be in the late 20s for EBITDA. I think all of this has helped us set in place the key drivers for margin expansion, and to set in place the foundations for growth going forward. I'm now going to ask Peter to talk a little bit more about the businesses.
Thank you. We're going to go in order of size. So we'll first cover the CDMO business. And I'll cover some highlights of this business, and then John and Stu will give us some additional color and background. The first thing we want to share that we think really makes this business different is our integrated services across the cycle, ranging from particularly strong from phase 3 to launch. And we'll cover several examples. I think John will have at least 3 he'll cover in his section in terms of trying to bring this to life, but we think this is an important area of differentiation. The second is we've successfully supported more than 40 launches for our customers since our inception, and 4 of them were just in last year. And if you look ahead, we think that number is only going to go up. We have strong R&D, and we're particularly good in the area of niche capabilities and technologies that I mentioned earlier, including such things as high-potent API, sterile fill finish, and antibody drug conjugation. And we have a wide range of existing customers that we just have to go and keep them happy and go deeper with them, and there's a lot of runway. On offerings, I'm just going to focus on the last bullet, which is we have, through our conscious strategy as it's borne out over time, we have gone from having 8 on-patent commercial products in FY17 to having 19 in the current year as on date. And we expect that number is once again only going to go up. And as I'm sure you can appreciate, when you have a recently launched on-patent commercial product, A, it's recurring revenue, and B, it's almost always growing. And C, it's often higher margin because of the nature of where it is in its life cycle. From a capability standpoint, I can't emphasize enough how important it is that we have important and meaningful delivery facilities in North America, Europe, and in India. That geographically balanced sourcing options allows us to not have to force an option on a customer. Instead, we ask the customer, what is most important to you? And then we provide the relevant facility to meet that need. If we look next, we have done a number of acquisitions over the last few years, and we expect that with the Carlyle investment support that we can do even more. And if you combine the organic growth opportunities we see from what we already have and add on top of that the ability to continue to add exciting new capabilities to further make ourselves even more relevant to our customers and add more pieces to our integrated service offerings, we can only see that go more rapidly. I just want to mention one additional point, which is the bottom right, where you can see that the revenues from what we've been doing at NC Development have been growing particularly more rapidly, and that really does feed the commercial pipeline, and that allows us to have even more engines for the later commercial revenues, as I mentioned. If we go to the next slide, what we'll do is we'll kind of share a little bit of the outline of what Stu and John will cover in more detail. We'll give you some more color on the underlying market and what makes it attractive. We'll give you some further information about what we do in this market, and in particular, our integrated capabilities. We'll show how that translates into a really exciting customer base. And then we'll cover a little bit more the technologies and capabilities we have and why we think that what we have to offer is compelling and why people are interested in it. And then we'll tie it all together and describe to you how this will lead to a really compelling, faster than past and faster than industry growth rate in the future. Without anything further, Stu, please share us a little bit more about the market.
Thank you, Peter. So the pharma sector, the outsourcing sector, is a very attractive market. You can see that it's growing. R&D is growing. There's a tremendous unmet medical need for a variety of disease states and therapies. In some ways, our business model is we're therapeutically agnostic, although we do have a major play in the cancer therapy, oncology therapies, which John will talk about. But you can see some of the drivers in pharma leading to a big market for us and a big opportunity. We focus most of our activities around what we call small molecules. These are active pharmaceutical ingredients that are basically taken by pill or other dosage forms, but are not what the industry trend is called biologics. We're doing chemistry. And you can see that 73% of the molecules in development are coming through this small molecule focus. The other part of our strategy is the emerging pharmaceutical sector. And when we talk about that is some of the companies that we call 500 employees or less, but also have a concentration by geography, being in Cambridge, Massachusetts, San Francisco, in the UK, in the Cambridge, Oxford areas. This is where innovation starts in pharma. And what happens later is those companies get to a certain stage in their company's evolution, and they're either acquired by a big pharma company or they take the molecule to commercial themselves. But we focus and call on all these companies, but we do spend a lot of time in the emerging sector where development comes from, where the engine for growth. Next slide, please. So again, the outsourcing market size is huge. The outsourcing market size is a large market. And gives us an opportunity, and it's also fragmented. So as you see in the pie chart in the middle, the top 5 CMOs only account for 15% of the market. So there's plenty of room for growth. The market is growing at 6 to 7%, and we're growing at double-digit rates. So we're actually growing it faster than the market, and that is always part of our plan and how we sell to the market. One of the other things we should talk about is we're actually located with our sales engine in those markets. So we have people who live in the markets. Pre-COVID, there's a lot of networking. It's their own brand they're selling in addition to the Piramal brand. And that has played out for us as part of our strategy. Why outsourcing is also important is the increased focus on the core competencies of outsourcing providers. The emerging biopharma do not have assets, so they need us strategically to help them support their growth. But even some of the big pharma companies have decided to focus on what they view as core competencies, and they need our technical capabilities. And the last thing is there is capacity constraints. We're talking about making investments in our own facilities with the support of our customers, whether that's in contractual commitments or even actually in co-investments, because there's a need to make sure they have capacity, because they can't have their product delivery be on the critical path as they're trying to get into the clinic or even get towards commercialization. So this gives us an attractive sector to focus on. John, over to you.
Thanks, Stu. As a large CDMO, we cover API and drug product in all phases of the drug life cycle. Our geographic coverage is in each of the major markets to service our customers. And really, the key here is when we bring a customer in at early phase, they're sticky. We progress them through the clinic to commercial within our network of plants. Switching costs are very high, and it's very time consuming. So, our capabilities and global footprint lead to a high rate of integrated programs, and this integrated feature is supported by the majority of our sites. This could be within a geography, or it could be across geographies, and I'll give some examples in the next slide on the integrated platform. This has enabled us to create a deep, and really enviable pipeline. We've got about 120 molecules in various stages of clinical trials. All this flows to a similar number of commercial, API and drug products. It takes time to create this. It's not easy to develop a pipeline like we have. I would say we're at an inflection point of significant growth, and we're investing in major expansions across our network in all our plants, most of our plants. In North America, 3 of our plants, major investment, 1 in Europe and 1 in India. And this is really proof of the scalability of our CDMO platform. And our high win rate, which you've heard about 50%, really underpins the success that we've been seeing. So you can see the chart below. This gives an overview of the competitive landscape, and we're one of the few fully integrated players with scale and runway to grow. So difficult to forecast where we're going to land on this, but we definitely see, based on the pipeline that we have, we definitely see moving to the left of that chart. Really good position today, and the pipeline really gives us the ability to move to be a significant player in this space. And just a bit on integrated. This model is a key driver to our success, and the capabilities that we have are another key driver. But talking specifically about integrated, currently 45% of our order book are integrated projects, and our goal here is to go really deep with our clients and our customers here. The benefits are significant. You can see those on the left. The one that sticks out the most really is speed to market. In many examples, and I'll give a couple right now. A key one is a Japanese client who just got commercial approval for a therapy for head and neck cancer. This is in Japan, and we're supporting that launch as we speak right now. This is an ADC that really, ADC is antibody drug conjugate. Complex API that's targeted with the biologic and a very potent API. This starts in Aurora, Canada. Just outside of Toronto. We make the API there, and then it moves to the UK, to Grangemouth, Scotland, and there. We do the conjugation, then it comes back and we do the sterile fill finish in Lexington. So complex network of support that we give this client in multiple plants. And this is a really good example of how we leverage the capability of our plants. There's some other ones, particularly on the API side. We have a client in the U.S. that has an approved therapy. This one is for this is for migraine therapy, and we start. We make an API. They have a supplier in Italy, and basically they needed a second supplier. I mean, security of supply is very important in our space, and they came to us. We using our Annur facility in India. We make an intermediate, we move it on to another plant that we have in India. So we make the intermediate in one spot, we make the API. It's a 5-step, very complex API. And to do it in the time that we did it was hugely important. One example there, and security of supply is huge. Another client in the U.S., they're late stage phase 3 clinical trials. That client, really was the origin of some of the key work that we have at our Riverview plant in Michigan. And there we make an intermediate again in India. We move it to our plant, another plant in India, where we make an advanced intermediate, and then it comes back to the Riverview, Michigan site where we finish the API. And this really underpins, the big investment that we're making that you've heard about in Riverview, Michigan. $30 million investment really underpinned by this client. So, that's a key element. And you can see at the very bottom of the chart, going back to the, Japanese client, you can see that the growth of that molecule that crosses so many of our sites. And really, this is just one market. This is Japan. We have Europe. We have the U.S. We fully expect it to do very well in those markets. Back to you, Sue.
Thanks, John. So again, we talk a lot about our services and our capabilities. and our integrated offerings that grow the healthy order book. And when we talk about the order book, this is the new work we win in development that eventually goes into commercial manufacture at some point in time. Peter talked about the strategy over the last 4 or 5 years and how we've had a healthy mix and pipeline of activities in all phases of development. The stages of drug development start in discovery, go through preclinical, the variety of phases, and then commercialization and launch, and then even post-launch. You need to have a balanced portfolio. There's a high rate of attrition, but as our phase 3 molecules go through the final approvals and they get launched, we're with them. And right now we have a healthy portfolio, over 30 projects in phase 3. In our models, even if we assume some of those don't get to launch, we still have a very healthy portfolio that is the driver and the engine for growth. Our revenue has increased through this. We've had an increase in our order book and integrated projects of 5-fold. We continue to do this. Again, you've heard 45% of our order book is in integrated services and capabilities, which leads to where we want to be as an organization. Next slide, please. So one of the things that we talked about, and Mr. Piramal talked about at the beginning, is how we sell our core values, the focus on patient centricity. And it really is a driver of some of these commercializations and finding these customers early and partnering with them all the way along the journey. And even though we don't actually talk to the patient or really know the patient per se, the patient is who pays our bills at the end of the day. It's our customer's customer. So we interact with them and really have a focus on making sure we do everything we can do to serve a patient. And that has played out with some of our molecules that we start in the beginning and go through launch. There's a couple of examples. We have a West Coast biotech company that is working on a drug for muscular dystrophy. We were able to start with them and partner with them early. They used 2 of our sites in India, both a chemistry site, an API site, drug substance site, and a drug product site. And we met their timelines, which were completely challenging, and actually over-delivered. They addressed our staff and thanked us and shared the work we do and the patients they touch, because without this therapy, unfortunately, some of these children will not get to live a long life. It's powerful. And our deliveries help them in a potential IPO. So that's really important that we have a strong pipeline, strong connection to our customers, strong focus on our patients that we serve. And with this pipeline and our ability to handle it all the way through the life cycle of development to commercial, it is a unique edge. And the East-West capability, which we talk about, that we're global and we're local to our customers and can give them a variety of options, which gives us, our customers, flexibility to choose where they want to launch, how they want to launch, what are the drivers for their launches and their geographies. Are there financial decisions? Are there geography considerations with regulatory? So it's a lot of work that goes into the flexibility of how we react and behave with our customers. And we're very focused on that. So again, it's a diversified, we talked about this, Peter mentioned this, blue chip customer base. We work with all sectors of pharma. You can see on the bottom right, we work with big pharma, we work with generic companies, we work with emerging biopharma. The emerging biopharma market, again, sometimes these customers and companies get bought out by big pharma and they just transition right into those pie charts. So we have over 500 customers, but we don't have any major revenue concentration with customers. Our largest customer today contributes 6% of our total revenue. Each site has anchor customers, and with our strategy, we're able to do more with these customers, go deeper with these customers. The story that John talked about the Riverview client, we backward integrated them into 2 sites in India to reduce the supply chain complexities. So we really have that ability to go deeper with our customer base. And we sell in all markets. I think that's also important. We see North America, it's still a main driver. Europe is still a business with lots of pharma companies, a little bit more concentration of big pharma than the emerging side. And Japan is a very attractive market for us. And we have many different deals and customers with long relationships in Japan. So these are sticky relationships. They help us along the way. And again, I can't underestimate the flexibility of how we sell to these customers. One of our large customers had a need and had a change on the fly of demand for a patient in oncology. And we make 4 of their molecules for them. And they needed us to all of a sudden drop through everything and focus on manufacturing one of these products because they were going to run out of the product for customers. And our Riverview site is able to flexibly work with the customer, work with their supply chain to make sure that we had raw materials to manufacture that. And we were able to do that. So again, that helps us because the more we deliver, the more we build references. It's a word of mouth business also, and we win business that way. And especially in the times of COVID, we've been able to draw and drive our revenue book to record numbers. And we're not even visiting our clients per se, face to face. So I'm really proud of how the entire organization, because everybody in our organization is in sales, whether it starts with Peter down to the shop floor, we're all helping support customers and patients. John, over to you.
Thanks, Stu. And we talked about integrated being a key differentiator, but you need more than just an integrated offering, and you need some hooks, and we have several hooks, as you can see on the right. I mean, I think on the API side, it starts with high potency. A growing number of NCEs being developed are all highly potent. This requires dedicated suites that have the isolation technology to work at a nanogram level. And when we bought Riverview, I mean, they had potent capability, but we took it to another level. We invested in 2 suites to do that nanogram level of API manufacturing. And a lot of these APIs go into ADCs. I talked about the example with our Grangemouth site, where you're combining a biologic with a potent API to get an improved patient outcome. Another key hook that we have. And on the drug product side, these potent molecules, a lot of them go into injectable formulations. And there in Lexington, we bought a site that was pretty much development, and we turned it into a commercial platform. Invested in commercial kit. And the key technology for sterile fill finish that really differentiates us is the isolation ability. Making these, doing these, aseptic sterile fill finishes in isolator technology. And this has been a key feature of the Lexington site. And although and when you talk about sterile fill finish today, it's almost a perfect storm. Given the COVID situation. And a lot of capacity is going to making vaccines. Our kit, doesn't lend itself necessarily to vaccines because it's geared up towards doing very potent, complex, injectable products. So we've got, I'll give you one example, but there's several more to come. And really, it's people that have dedicated their capacity to doing vaccines. We've got a transfer that's coming in. It's a first to file generic peptide product that uses our technology to isolate. So these are key elements of differentiation. Complex technologies. We also do hormonal, and on the solid oral side, we covered the gambit. Not only the immediate release, but the sustained release. Products that require complexity. So a lot of differentiating hooks that we have, and a lot of these play into the oncology space. If you look to the right, you can see that doing potent APIs. A lot of oncology products are injectable. ADCs, all injectable. Deep pipeline. 65 programs, 7 of which are integrated. And you can see the numbers in terms of the market for these products. So a lot of capability here. to differentiate ourselves against the customer base that's out there. Over to you, Peter.
Thanks, John. So how does this all come together? What we believe we've described to you and what we'll try and synthesize here is that, first of all, this business over the last few years, as we've implemented the strategy, we've shown above market growth rates and we've shown margin expansion and we've shown increasing capital efficiency. So a lot of this is started to play out and we expect it to play out even more in the future. We should see all of those metrics in the medium term improve. Now, how is this all going to happen? Why should you believe that the trend should be better in the future than it has in the past? And even the past has been an improvement. I'll explain that a little bit through a few sections. The first is on capacity. We're going to be expanding capacity of our existing facilities through operational excellence. Now, every pharma manufacturer of some sort would do this, but it's the most obvious first step because you can take the existing employees, existing capital investment, and you can get more capacity faster with less cost than anything else. So that's obviously job one, and we think we're good at that, and we're going to become better at that. The second is that we, as Stu mentioned, we have a number of customer-led expansions at a number of our facilities, actually across all three geographies, where if you look at their demand projections and our capacity, and even with the best, most heroic OE efforts, there'll be a gap. And they're concerned about explaining to their stakeholders, when I want to make it, can I make it? We have a variety of different levels of commitment arrangement to allow them to provide that level of comfort that when they need that, they'll have it. We have semi-dedicated capacities and different types of arrangements that allow us to have confidence that when we build this out, it'll be utilized, and our customers have confidence that when their project succeeds, they can make it, and that won't be the reason why they wouldn't succeed. The second area John talked about at great length, so I won't repeat it, but we believe we have a number of hooks or magnets that pull people to us that we think that we'll want them to get to know our network. And once they get to know our network, as those examples we described, there'll be a whole lot more we can offer them. And that integrated offering will then, in and of itself, then become sticky and will become very relevant and important to that customer. The next area is that we have many angles of growth with our customer. The first is we just need to continue to progress along with the molecule or the products that we're making. As those projects progress, we need to continue to meet the customer's expectations and we'll grow with them. The second one is, I think, more tangible near term, where as Stu mentioned, we have 30 phase 3 projects that are currently being served across our network. This is more than we've ever had before. And let's say you only take half to succeed, which is the industry average over a long time horizon. That's going to give us much greater growth than we've had in the past. And this is high quality growth because this is the on-patent, early launch, growing, higher margin business where things like speed and quality and stock availability become more important than other factors. The next one is that we've already launched and have on market 19 on-patent commercial products, the highest we've ever had in our past. And it's growing significantly over past periods. That's also going to be growing. So this late stage, early commercial bolus as a result of our multi-year strategy coming to fruition is putting us at an inflection point. I think the next point is that good win rate driven by the attributes we described that we think position us well vis-a-vis our competition, we think will allow us to continue to fill the bucket with new interesting development projects that should allow us to continue this story if we continue to impress our clients with our actions each day. And then finally, we do believe that we've gotten compelling market traction with our integrated project offerings, and we would like to continue to build on that trend. And as projects develop in our pipeline and eventually to commercial, an increasing share of not only our order book, but later our revenue will be from this category. And this is an important part of distinction for us. I just wanted to bring one other point. While the slide title is revenue, when we do this strategy, and in particular when we add revenue and capacity to existing plants with this organic part of our strategy, it really is good for margins because you don't have to hire a second plant head. You're hiring more operators, and you're not adding all of the ancillary utilities for a second site. You're just adding the related reactor bays or equivalent. And so these brownfield expansions and this going deeper with the customer at our existing site network allows us to improve margins and also improve ROCE at those locations. However, with this strategy, we believe that we will become even more relevant to our customers and even have a better growth plan if we can add certain capabilities that we could add to our integrated offering basket. And so we have a list of go-get technologies that we're looking for, and we expect to, and our locations, and we expect to add those over time. And that will allow us to take our attractive organic growth rate and add on top of that some inorganic growth, particularly with unique capabilities and or geographies we don't have. And the recent Sellersville acquisition is an example where we acquired in the US the ability to do solid oral, as John mentioned, and in particular, potent with a pathway to high potent in the US. And that's an example of a capability add that our customers were screaming for, and we were just handing business to competition. Now we can offer it. We're going to have more of those to show in the future. And so that's why we think that this business is pretty compelling, and we see a tangible, granular, definable growth plan for organic with inorganic on top. So I think that's the CDMO story, and we can maybe shift gears and cover a little bit of the complex hospital generics business. Once again, we think we're one of a small number, if not very few, companies that are uniquely focused on the hospital, surgical center, veterinary market, where surgeries, if you will, or people need care in institutions where they go to get that care. Within that, we're one of the top 4 players globally, and if you exclude China, we're one of the top 3, and we think we're one of the more rapidly growing players in the areas of inhalation anesthetics. In addition, a few years ago, we added the strategy to get into the broader injectables market, and we have a strong presence in that market, and it's growing through our pipeline. If you look at the next area, our portfolio through those actions now covers not just inhalation anesthetics, but also injectable pain, which we acquired initially from Janssen, as well as intrathecal therapy, which we acquired from Mallinckrodt, as Nandini mentioned, and also some antibiotics, which we brought in through different licensing arrangements. And on top of that, we have a strong third-party developed and manufactured pipeline that allows us to pick what subset of products we think, even within the already comparatively attractive hospital market, would have better attributes and better ability to perform. And it does vary from product to product and from country to country and product country pairs. And Michael will describe a little bit of our art and science behind choosing where to compete. And then within capabilities, we have mentioned this, but we do think there's kind of 3 key ones. The first is that we have our own vertically integrated manufacturing capabilities, and that's because there aren't many CDMOs you can go to get this, and it's actually one of our competitive advantages. The second is that we have a great network of partners who think we are their partner of choice because of how we will commercialize it, and they are our partner of choice because they have a great product and good quality and a reliable supply. And we can now sell this through our direct capabilities in key markets and partner capabilities in other markets. And this is a business where we believe that we have done M&A successfully, and that with the additional capital from Carlyle, we should be able to do more M&A. And I'll just pick one additional highlight on the lower right, which is before we had diversified into this broader range of offerings, we were highly concentrated into sevoflurane within inhalation anesthetics, and beyond that, we didn't have much. It was good, it was profitable, and from a purely financial perspective, it may have looked like a good place to be. But now if we look in the COVID pandemic, that particular offering, given the fact that people were not able to or willing to go to hospitals for surgeries, did experience challenges of demand. People weren't able to get surgeries. Our other offerings continued very robustly through this period, and that's an area where diversification of revenue provides a benefit. And we do believe, obviously, the demand will return, and Michael can cover that later in this section, but this strategy of adding multiple engines of growth, we think, can only make the growth more reliable and more predictable in the medium and long term. So now I'll quickly cover the outline of what Michael will cover in this section. He'll give a little bit more granularity and context behind why we think this market is comparatively more attractive than other generics, of which many of our Indian listed peers are present. And the second is he'll cover a little bit more about how this comes together as a platform, in particular around what our particular products are, how we go about commercializing what we make or have made, And then finally, how we go about making or having made those products. And then at the end, I'll summarize how this is going to lead to continued high growth as we've had in the past. Although obviously this year we've had the issues relating to the hospitals and surgeries, but overall long time horizon or a medium time horizon, we'll share the growth picture. Michael, please.
Thank you, Peter. And I just wanted to say, thanks to all the participants. Good evening, good afternoon, and good morning. I think one thing that, as I listened to the introduction from Peter, I think he did a great job covering and describing what we find important. But I also want to just connect some of the things I heard from John and Stu, and they emphasized a strategy that is designed to be relevant to our customers. And I think that our customer centricity throughout the larger pharma organization really is emphasized as well within the complex hospital generics business. And I think that not only that strategy, but our overall emphasis on values is demonstrated through the way that we look at our business from the customer's eyes. And the customer for us is ultimately the patient. So we focus on a large market, but as you can see at the bottom of this slide, over the global pharmaceutical market in which we play is a giant one. But we are focused on things that are delivered to the patient in the hospital by the hospital system or through a surgical center, and to a lesser degree through home care. But it's basically injectable drugs added to a very strong platform of inhaled anesthesia. And why inhaled anesthesia is such a strong platform on which to base our business is both our expertise and manufacturing capability in that area, which we are really the only, plus our marketing capability. We are really the only global player who's vertically back integrated, and then through our own sales teams in key markets, sell the product directly to the hospital. So we go all the way back to starting materials in our key products, and then basically responsible for delivering those products right to the hospital where they are administered. So this creates kind of an end-to-end role in this business of inhaled anesthesia that separates us from the two or three other leading players in the business. And on that platform, we were able to add products, as Peter mentioned earlier, very efficiently, where we can simply in-license, acquire, or otherwise get the marketing rights to a product in a country where we're operating and add that to our system. So really anything that's delivered in those to those customers, the hospitals and surgical centers and veterinary clinics that we serve, we can add without much disruption and with very efficiently and with very little additional cost. So what we're trying to do is find the right products that fit into that and give us an advantage and give our partners, and we call our suppliers basically our partners, because in one instance, we're a key manufacturer and we have partners in some countries, but what we are trying to do is offer our marketing capability to other manufacturers so that we can have a wide range of products, which we'll talk about more, but we have a very wide range of injectable products that we've added to our inhaled anesthesia platform. The inhaled anesthesia is differentiated in that it requires dedicated manufacturing plants. We own those. We have those. We make all these products ourselves, and it's very hard to enter that from that perspective. It's also hard to enter that business from a marketing perspective because we have developed and provided to our hospital customers the vaporizer that is used for our drug to be administered to the patient through the anesthesia machine in the hospital. And it's through a different range of arrangements, from basically allowing them to use the vaporizer in exchange for a commitment to buy product to more of kind of a purchase lease type arrangement or other arrangements that tie us to that vaporizer, and which in many cases we still own, and it's at the location of the hospital. Peter talked about, and Nandini mentioned the Mallinckrodt acquisition, where we acquired the Intrathecal business from Mallinckrodt just about 4 years ago. The main product there is gabapentin, and all the products in that portfolio, which include Metigo, which is intrathecal morphine for chronic pain, are administered through a pump that's implanted in the patient through a surgical procedure, connected to the intrathecal cavity, which is the space around the spinal cord, by a catheter, and then the pump within the patient is filled with the relevant drug that we supply. We do not supply the pump, but the drug product has to be approved for use in that particular pump, and our products are approved for the leading pumps. And this creates obviously a very close connection to the patient. These patients are generally suffering spasticity symptoms relative to spinal cord injury, brain injury, cerebral palsy, and MS, and other conditions that could create this muscular spasticity that is relieved by the intrathecal baclofen. So it's a lifelong commitment to this drug for the patient, and once that relationship is established, we are very good about maintaining that business. I'd also say that in the United States, where this is currently the primary market, we have a specialized sales force that sell these products. Again, kind of completing that link to the market from the manufacturer, the development of the drug, right to delivery to the doctors and nurses that administer this, and both install the pumps and then refill the pumps, or fill and refill the pumps. So we have a highly differentiated product line playing in a very large space. Next slide, please. So in general, as I said, the products that we've added to the inhaled anesthesia core are injectables. And generally speaking, injectables face less competition, better pricing, and better commercial environment than standard oral generics, and particularly some other standard generic products, non-injectable products. There are fewer companies in the world that are making injectables than that make solid oral dose. There are fewer companies marketing those products in the United States and in other key markets. In some markets, there are very few companies that market injectable products. And overall, there's less competition, and there's less price pressure. The other thing that's unusual about us is the number of countries in which we operate. So there are some other companies that are focused on injectable products, or more broadly hospital products, but they generally don't operate, other than the major global players and big pharma, operate in as many countries as we do, both directly and indirectly. So that differentiates us, as Peter mentioned earlier, in attracting partners, manufacturing partners or development partners, who are looking for an outlet for their products into the market, and we can provide that across multiple geographies. So when Peter mentioned, we launch a product, and we can do that rather seamlessly now, and it has been a journey, and it's continuing a journey in some countries where we are getting more established, like France. We recently launched Desflurane and some of our sevoflurane variants that are particular to France. We can add a product without much hoopla, without much concern, and that's easy for us to do. It's not that easy for some of our competitors, particularly when you talk about the number of countries we're in. So we don't have to just launch a product in the US. If we find a product that is appropriate and has a strong market in the UK or somewhere else, we can find either a partner, or we could do it ourselves directly. So we have a lot of options to introduce new products, and injectables are the focus. Next slide, please. So this talks a little bit more detail about the products. I think I've covered a lot of this. Inhalation anesthesia, you've heard there are 4 major players. We are the 3rd largest if we don't include China. There's one major player in China who dominates that market, and most of their revenue comes from that market. There are smaller Chinese and other global competitors that supply primarily the API to other markets, but we are, I'd say the strongest in terms of our focus on inhaled anesthesia. All of these other companies sell a lot of different, make and sell a lot of different other products. Some of them are not made by them. They don't all make their inhaled anesthesia as we do. As a portion of our business, inhaled anesthesia remains a large part, a large percentage, which gives us the right to focus on it, and we focus on it much more so than any of our competitors. On top of that, we've added the injectable products, the intrathecal products, and then other products, not just injectables, but other products that are administered primarily in the hospital, including miglustat, I point out, is not an injectable, but it is used in a very rare couple of diseases. It's not technically an orphan drug, but it is administered, or it starts the administration in the hospital based upon a diagnosis of one of those two rare diseases that it treats. So that's pretty much the portfolio. One key thing about our intrathecal baclofen, which we call gabapentin, is we have the only pre-filled syringe presentation of that product. We compete primarily against products that are in ampules, which in the US and a lot of other markets are now less preferred to vials, but also for ease of administration, the pre-filled syringes are preferred. And we have the only product in that presentation. Next slide. So I think we've grown the business on a pretty fast trajectory from revenue, in large part by the acquisitions we performed, but also through organic development of our core inhaled anesthesia business, which has grown very, very nicely and continues to grow our share in the global market. And we believe, as Peter mentioned earlier, that that share will continue to grow based upon the reasons we've all discussed about why we stand out in that field. Obviously, the key growth drivers, as we talked about, are expansion into other complex hospital generics, increasing not only our direct sales capability, but the revenue that we put through our direct sales team, which is really the key to our strategy, adding products to our core, and then delivering them to the customer really through the same channels that we deliver our core products, our inhalation anesthesia. And we've done that successfully, both with acquired products that we talked about, the intrathecal portfolio, the Janssen pain injectable portfolio, but also through every product that we in-license or otherwise acquire over time. The supply chain really requires some attention, and I don't know if any of us have given it a sufficient shout out in terms of what our supply chain team is capable of now, both within Piramal Critical Care, the complex hospital generics business, or in the broader Piramal Pharma organization, or even throughout PEL. We all know that supply chains have been challenged during COVID, and prior to that, we built a very resilient supply chain for our complex hospital generics business. And we've proven through the disruptions of the pandemic that it is a robust, resilient supply chain. And not only is it robust and resilient, but it is scalable. We can add products, we can add APIs, we can add raw materials to that, and ensure that we maintain delivery to our sites, delivery to our customers, and we've done that remarkably well during these last 12 months under great challenge. I think it's important to point out we did experience some price increases around the cost of logistics, let's say, and the cost of supplying those products, but we never experienced an interruption, which is key when we're supplying life-saving and life-improving drugs and other therapies. And then on top of this, and we talked a lot about this, but the adding of strategic acquisitions. So we are well placed to as a platform to identify, assess, diligence, and add both companies and products that fit with our strategy. I think it's important to emphasize that we operate directly in the key EU markets and in the US. We have subsidiaries in Australia and South Africa and some other key markets where we want to be present in the market. But we also leverage local partners, even in some of those markets and in key markets like Japan. And this combination of market access in strong markets, together with our core manufacturing and R&D capability and the leverage we have throughout Piramal Pharma, gives us the opportunity to acquire a lot of different kinds of targets that might have products for use in EU but not in the US, for US but not EU, or even globally. So we are very
Peter, would you like to take up? I think there's some noise disturbance.
Yeah, I think we got some.
Yeah, maybe if you can take up this from here.
I think we were wrapping up this slide 3B, and he was just giving some good examples around potential acquisitions. We can now shift and cover, while he returns, to discuss our balanced mix of product sourcing. I think an important way to start on this slide is that if you look to the very right, if we want to pick the right combination of product and country, we want to be able to make sure that we pick the right dosage format or form to use where that'll most likely succeed. And if you were to try and make everything yourself and develop everything yourself, you would need to have a very large, complex, and expensive plant. But if we are able to work with third-party partners who would provide these for us, we can actually find the best manufacturer and developer for a particular product, a particular format, which is very rarely always the same company. And then if we look to the left-hand side of the slide, we can discuss the different models. And I think Michael is back now if he would like to continue. I think we had an internet snafu, but I only so far, Michael, the benefits of third-party from a dosage format and best of breed perspective, if you want to cover the left.
Okay, so yeah, so sorry about that interruption. I'll move through the left quickly. We have internal R&D that we leverage. We really have done a great job of establishing relationships with external partners, both from a development and manufacturing capability. And we have a steady stream of opportunities, both that we have initiated and that our partners have initiated and offered to us, which we kind of categorize as licensing partnerships, but it's a very fine line. And one thing about us that I think we should emphasize is our flexibility in deal terms. Some partners like to own the MA, and if they do, we can manage with that. Some companies say, oh no, if I can't own the MA, I don't want to market the product. We are much more flexible. We're comfortable with long-term commitments on licensing that give us secure access to the product, even if we don't technically own the product. Obviously, our preference is to own the IP and to control as much of the product as possible. This is not always feasible or in the partner's interest, so that we are able to make arrangements both with external R&D capability companies, as well as a direct out license, which would be covered in the kind of the licensed products. And then again, I think I talked a lot about acquisitions. The nice thing about in-licensing or other arrangements with marketing, but with manufacturing partners, is that we can be very careful with our capital. We have access to certain products where it really doesn't cost us anything other than, or it doesn't cost us anything to market those products. And obviously, maybe the margins may not be as high in those cases, but obviously our costs and capital investment is almost insignificant to add those products to our portfolio. And then, I guess, Peter, you covered the dosage forms. I think we've covered that in more detail. So we could go to the next slide. And here again, and I mentioned this, our global reach. We have a very unique platform in that we are direct in key countries, but we also distribute and supply our products in over 100 countries. And we have that gives us relationships not only with the distributors that we work with in those countries, but the tender authorities, the regulatory authorities, and we are well known. Just recently, Mexico is not a very important market for us at the moment. We are trying to develop our business there, but we were invited to participate in a UN-based tender in Mexico, and it's early and it's not complete, but we participated across a broad range of products, even though we're not physically present with a subsidiary in the country. And it was a great effort by the team. Now, where we are present, like the US, we have even greater successes. And, we just recently are in the process of launching dexmedetomidine, and we secured the largest GPO award for this that is basically for the next 7 years with a company, GPO called Vizient, where we get access to the largest share of hospitals in the United States. The key there is that we haven't even launched the product there, and we have secured that award, and we're going to have that business locked up for a period of time. So our presence in these countries across different geographies is very important to our overall growth. Next slide. And then I think I talked about our real strength in inhaled anesthesia manufacturing, which separates us not only from the crowd in the sense that very few companies have this capability, but it even distinguishes us among the companies we compete with in inhaled anesthesia. Not all of them have the back integration that we do, and not all of them combine the vertically back integration with our direct marketing and sales capability in key countries. So, and then as we should mention, we have announced that we've acquired 100% interest in our specialty chemical facility in Dahej, which was a JV and now supplies us as part within our own organization, a key starting material for our key product, sevoflurane. So when I say back integrated, we are truly back integrated, not just to API, which we make in the same plant where we make the finished product, but we are back integrated into the key starting material for our largest product. Next slide.
So thank you, Michael.
Go ahead, Peter. You're welcome.
So with this slide, I'm going to briefly cover why we think that we're going to continue to have profitable growth, and we should see continuation of what are already attractive margins and an improvement in capital efficiency. The first is, if you look at our core products of inhalation anesthetic, per recent IQVIA data, we're probably 15% global market share. So we're far from the end game in that market. We think we can significantly improve that. And to make it more tangible or specific, in our largest market, the US, the largest GPO recently just awarded us a dual award, which previously up until then was always a sole award with the same provider since the product was available. And we expect to get more than our fair share of that over time because of the offering we provide and the service we provide. In addition, Michael mentioned the example in France. The sevoflurane requires certain variants, in particular with something called an integrated closure, which prevents the gas from escaping from when the bottle is put in the hand to when it's put in the vaporizer. And we now have that offering available in those markets, and we expect to launch and do well in those markets where that was a sales objection for certain customers. And so we expect that too. I'm just giving two examples as to why we should be able to believe beyond just our past track record, growth should continue in this product. Secondly, we've launched desflurane in UK and in South Africa. And with the addition of additional vaporizer options in the coming quarter, and later the subsequent launch in the US, we think that we should be able to sell quite a bit of this product going forward in due course over time. And then in the case of injectable anesthesia and pain management, while owned by Janssen, you can imagine in a large company such as that, the on-patent new commercial launches probably got the lion's share of attention and focus. But for us, these products are key and critical. And also we're going to have more control over the supply chain once we've switched the third-party manufacturers to ones who are more interested in growing the business than the prior one. And overall, we expect that business to perform well with that dedicated focus and more secure supply chain. And then as we look ahead to the new product launches that Michael described, we've got several already, I guess, in this quarter, if you will. We have the dexmedetomidine, which was mentioned, succinylcholine in the US, both. And another example, ex-US, where we have teicoplanin in Italy, which we actually won the tender based on the discussion with our product supply partner, and then we've now got the whole country for them. And that's an example of the nimble deal making. And then you combine that with the inorganic, and we can take good organic growth and make it even more robust with inorganic. And I don't want to repeat a lot of what Michael said, other than to say that if you look at our past track record of 19% CAGR over nearly a decade, we should be able to have pretty healthy growth going forward through the combination of organic and inorganic strategies. We can now shift to India consumer healthcare. And on this one, I'll pick a few components. The first is we're obviously one of the largest players in this area. And if you look at our particular flavor, we're one of the most relevant ones in that area. And we have 5 really important brands that we think with the right care and attention and focus and investment, they can become even bigger. And I mentioned earlier in the section about the benefits of e-commerce and how we've really developed some muscle in that area, and we hope to get even stronger and better. In terms of the offerings, beyond the 5, we have more than 20 other brands, or 20 brands in total, and we reach a significant number of consumers each month and frankly each day. And of our brands, in the context of India on OTC, a number of them are salient. We have a significant number of employees. We cover through multiple channels and approaches a significant number of people who can help us sell our product. And finally, a lot of this company has been a roll-up of acquired products in its past. And the new muscle we've developed is launching our own products. And if you combine our organic strategies, which Nitesh will describe, along with the ability to continue to add products to our capabilities, which combine both push and pull, push from the channel and pull from marketing, we think we can have pretty compelling growth here as well, in line with or better than what we've shown in the past. So let's give you a brief highlight of what we'll cover, and I'll do it quickly, is that I think we probably don't need to be shared that the Indian consumer market is attractive. And we hope that many of you will recognize or know a number of our brands. We will describe our asset light model, which we think focuses capabilities where we need them and uses partners where we don't. And also we describe our channel, which we think is distinctive. And then I'll combine it at the end to share how this is going to translate to compelling growth. Without anything further, Nitesh, please share some of the further granularity on our plans.
Thank you, Peter. So I think already the context has been set about our organization at large. So I'll focus here first on the market. And many of you already know the market, so I'll keep it brief. Overall, if you look at the OTC market in the country, it's about 19.5 billion market. And I broadly categorize it into 3 parts. One is about being healthy, which is curative solutions. So your painkillers, stomach health products, your cough and cold remedy. That's about 2.2 billion market. Then you also have supplements, which is all about staying healthy. And that's where your vitamins, minerals come in. And then there is a very large market, which is all about health-focused FMCG. And that's all about living healthy. So here you have product in the grooming space, in the personal care space, in the baby care space, where health-focused products come in a lot and add in a combination of care plus health together. And that market is very large. So put together, that's the size which is available for us, because most of our brands will operate and cover these 3 spectrums. Also, not to mention, if you look at Indian market per se, there are a lot of structural tailwinds which are available to us. We all know India is a very young country, very large young population, rapid urbanization, and also increasing disposable income. We also understand that many of our consumers even today use home remedies, and OTC is still highly underpenetrated if we compare it versus developed and emerging markets like East Asia. One is important trend which is happening in the Indian market is the shift towards modern trade, be it in the grocery space, but more importantly for us in the pharmacy space. And this transition to modern trade allows the opportunity to self-select. And that's also happening in the e-commerce space, where now e-pharmacies are emerging and even marketplaces are offering a lot of healthcare products. So that again adds the visibility, the range, and the ability for consumer to choose on their own. So these factors put together make the market much more attractive in the times to come. If we now look at our portfolio on the next slide, so this is where we do operate. So as a player, if we look in the overall healthcare market, we are among the top 15. If I focus more narrow in the space of pharmaceutical healthcare companies, we are among in the top 7 in the OTC space. But what really differentiates us here is our diversified portfolio. So if you look at the segments in the OTC space, we virtually are present through our various offerings in every potential OTC segment. So out of 19 billion market I talked about, we today have a play directly there in about 5.5 billion market through the various brands we operate. Also, with the potential to extend these brands into multiple spaces, we should be able to cover about half of the total OTC market in the country. So that's the space we operate in, and that makes us much more poised for growth in the future. If we now come to the brands on the next slide, now many of these brands, as you would be aware, are ones which we have experienced in the lifetime. So there are brands like Saridon, Lactocalamine, Supradin, iPill. Many of these you would have experienced personally also in your lifespan. And these are the brands which we really believe have a lot of potential still to unlock. They are still, while they are big, they can be still extended into multiple segments, into multiple formats, and can be made much bigger. And I'll talk about them separately. But in addition to these brands, we also have a host of what we call as emerging brands. And what we are doing in the more recent years is picking them up one by one and running various experiments to even grow these bigger. So I'll talk about one recent example of a brand, Tetmosol, which we started last year advertising in the regional market. So we started with the markets of UP, Uttaranchal, Bihar on print, and we took market of Andhra Pradesh in TV. And both of these models, backed with a regional celebrity, we found were giving us very strong growths. And based on that, we have now extended this into a national advertising. So we recently signed a national celebrity to back this brand. And that's what we are now going to make this brand also much bigger. A very similar experience on Polycrol, which is our antacid brand, where we started with West Bengal, but is now extended to Pan East and are also now going into Andhra market. So there are these examples of attempts where we are also making our emerging brands gradually bigger, and that makes us a total diversified portfolio of 21 brands, a strong powerhouse for growth for the future. If we now come to the next slide, now these are the 5 power brands where we invest significantly. If you look at their category rank, they are among the top 5 leaders in most categories we operate in. Also, if you look at today, for example, if I pick the brand like Saridon, today it's still a number 1 headache brand, but operates only as a tablet. If I look at possibility to extend this brand, it can extend into other pain indications. It can get into higher strength. It can get into other formats. And you can also get into contiguous cough and cold area, which often accompanies the headache. Similarly, if I pick our iPill brand, which we acquired about a decade back, that brand was synonymous with contraceptive segment for emergency use. We then extended it into iKnow, which is a ovulation detection kit. Today, this entire eye range stands as a range of solutions for women for her intimate care needs. And more recently, we have expanded them into menstrual cups, into intimate hygiene wash, and that's also going to drive the growth for future. The last one I'll talk about here is the brand Littles. Now, Littles was again an acquisition in the range of feeding accessories and personal hygiene in the form of wipes. When we went into e-commerce space with this product, we saw very, very strong traction. Combination of the kind of marketing efforts and advertising efforts we put on the brand, and also with the kind of USP the product had.
Now, with that, we recently extended this brand into diaper space, and we are again seeing very strong traction linked to our strategy of leveraging these power brands about getting into multiple new formats and multiple new areas. So that's about our power brands. If we now move to the next slide, this is how the business has really responded in the time of COVID. So when COVID came in, we actually looked at our long range plan. We added another new portfolio in total in the space of COVID. What was really important is the agility of the organization, because very, very quickly we were able to virtually launch 8 different products to meet the needs of consumers in the times of pandemic. And because we had very strong e-commerce network also being built, we were able to leverage that network to make each of these products highly successful via a combination of the right amount of product availability, range, pricing, and also continuous advertising behind these in the digital and e-commerce space. While we continued to do work on the COVID portfolio, we didn't lose track of our master brand strategy, and hence we continued to also launch other products which we had in the power brands area. And you could see our extensions in the area of lactocalamine, in the area of littles, or in the eye range. Those were also launched on track. Again, used the e-commerce network in a big way and were highly successful. If we go to the next slide, I think this Peter mentioned about our asset light model. So what we are really doing is we are focusing as a business our energies on marketing, on distribution, which is where we have our own strength. But when it comes to sourcing, we have a very strong network of partners who are able to give us the right kind of products in the right amount of time. So if you look at specifically the example of COVID, the same partners also allowed us to very, very quickly launch multiple new products in the area of COVID. What we also have is a very, very strong distribution network, and that also distinguishes us from the pharma peers a lot. So today we have a full-fledged network which covers about 210,000 pharmacies plus baby stores put together. We also cover all the wholesalers, both in the grocery and in the pharmacy space. And if I look at the total reach, both direct and indirect, as a company, we are able to deliver a reach of about 1 million outlets through our network. And that also gives us an ability to expand our portfolio, which we are seeing success in the e-commerce space, in the GT, in the general trade in times to come. Coming to next slide. I think this is some further details about our network. So per se, our network, which reaches to both chemists and cosmetics, we have 2 business units here. One which is specifically focused on chemists and cosmetics, and one which focuses on only chemists. Why do we have 2 units? Because we have built for a scale which is ahead of curve. Through the 2 business units, we are able to add multiple portfolios. So our strategy of acquiring new brands, new portfolios is being embedded in this strategy of having a future ready sales organization. So we have 2 teams, and we could add the relevant portfolio depending on the brand we acquire, either inorganically or what we launch organically into this portfolio. What we have also done in the last 2 years is worked significantly on making our sales team embedded on technology platforms. So we have invested on SFA, Salesforce automation system. Today, our entire coverage is tracked on a lat long. Our entire execution at the point of sales is again tracked on a mobile interface. So we have a real-time knowledge of what is our coverage for the day, what is our productivity of each rep on the field for the day, what is the kind of visibility execution he has done, and the lots. So through this targeted execution, we are also building a capability to really get our new product launches visible and available at each point of sales much more faster. In addition to our strengths in the general trade, if we also now come to the emerging channel, which is modern trade and e-commerce, I'll first touch on modern trade. Much like an FMCG, we have a very, very comprehensive coverage of all modern trade, be it the hypers, supers, and even the metro wholesale cash and carry format. So we have a full coverage, much like an FMCG company, and much better than any other pharmacy company. Then coming to the e-commerce. Again, on e-commerce, we have very, very comprehensive coverage for all formats. So the entire marketplace, which is Amazon, Flipkart, or the e-grocers like Big Basket, Grofers, or if we come to specialty stores like First Cry, which covers baby care products, or an Nykaa or Purple, which covers cosmetic. We reach all of them directly. So that's again our strength, which distinguishes us from pharma peers. What we also have is an embedded in-house analytics team, which virtually runs all our campaigns in the e-commerce space. What this team delivers for us is, it is giving us an ability to very, very quickly scale up success on our new product launches. Because we understand what the consumers are looking for, we are able to invest our monies on the right set of keywords, make our products visible, much better versus our competition, and through that get a much accelerated success. What e-commerce is also giving us is an ability to test, pilot new launches, which we can then scale up in the general trade. So that's again a future growth engine which we are creating via e-commerce for the organization. Last but the important one again for our litters, which is one of our strong power brands seeing very, very high growth. We also have a dedicated coverage of about 10,000 outlets, which is again through a direct field force, which is an optimized size, and again embedded on technology, much like our general trade force. So that's all about the business here. I'll now hand it over to Peter to sum up on what are the levers for growth.
I'll try and do this succinctly so we can keep on time. The first one Nitesh already mentioned, which is we are developing and have deployed and are using tools, and will use tools that will allow us to be more efficient, effective, transparent, and flexible with our field force. And that's something we're going to continue to build on. The second one is for our most important power brands that Nitesh described, we're going to give them more attention and focus in terms of A, investment in promotion or creation of pull, and B, line extensions and additional offerings to work under those compelling umbrellas. The next areas that we're going to, seeing how we've gotten and achieved good traction from e-commerce as a growth engine for not only our existing products, but also as a credible incubator for new products that can then eventually translate into the main areas. We're going to really build on that and double down on e-commerce, given what we've learned in the last months and quarters. And then all of these three will be enabled through an increasingly agile and effective organization. And we're going to really be modernizing and improving how we work within this. And we've already done a lot of that during COVID, and we're going to do even more. And some of this is described through some of the capabilities we're going to build to support that. And then with these four areas, we should see really interesting and attractive growth for this division on an organic basis. And all of these capabilities, if you just drop in another product, that product would blossom, and it would not require significant additional investment across all of these areas. And so therefore, that would be highly accretive. And so we would be looking to use the Carlyle investment money once again, in addition to the other two areas, also here, if we find the right opportunities. And so we think inorganically getting these additional brands, they all drop to the bottom line. And we can also often add revenue synergies because we may be more effective at selling them than the prior owners. So I think that wraps up this section in terms of the in-depth double clicks on the businesses that we directly operate. But we do want to let Vivek give us a very brief overview on ophthalmology, which is through our JV partner.
Thank you, Peter. So Piramal has a 49% stake in a joint venture with Allergan that was formed over 25 years ago. The joint venture deals in eye care products and has been a leader in this space in the Indian eye care market. Most of the products marketed by the JV are manufactured at our Pithampur facility, which offers a unique technology that provides a uniform drop size. The JV caters to a wide variety of eye ailments, and 4 of its brands figures amongst the top 10 ophthalmology brands in the country. The JV has had revenues of over 50 million and has been growing at a CAGR of 12% and has a PAT margin of 26%. With that, I hand it back over to Nandini for the closing remarks.
Thank you, everyone, for taking the time. I hope we've convinced you that we are targeting attractive, large, and growing markets with high entry barriers. Our businesses have a strong position in their respective market segments. In the CDMO business, the integrated solutions are the differentiating factor in that business. We have a track record of executing over 125 integrated projects and have seen a 5.5 increase in the order book of integrated projects from 17 to in the 9 months to 21. And we have an excellent track record in progressing molecules throughout the life cycle. In the complex hospital generics, we're present in categories with high entry barriers and are amongst the top 4 players of inhalation anesthetics globally. In the other products, there are also entry barriers such as intrathecal spasticity. In the consumer products business, we have a portfolio of wide brands that are present in 1,500 towns across India and are present in more than 2 lakh outlets. We also, as mentioned before, have a very experienced and global senior management team who you've heard from today. Our robust balance sheet and capital raise will help us augment both organic and inorganic expansion. It allows us to give our net debt to equity ratio at 0.5 and a net debt to EBITDA of 2. As we think about acquisitions, I think we may raise and go up for our net debt to EBITDA from 3.5 to 4 as we look at acquisitions in each of the 3 businesses. Lastly, a continued focus on quality, compliance, and patient and customer needs, as well as environmental health and safety, give us the table stakes to play and the right to play in this market. Thank you, and we're open for questions.
Thanks, Nandini, and thanks for the management team to explain this business in detail. We have the first question around the M&A/CapEx plans for the next 2 to 3 years. The question is, how do you plan to invest the capital that you've raised recently for inorganic activities? And are there any specific areas that you would be targeting?
So we have announced a capital expansion in our Riverview plant of $35 million. We're also in the midst of a capital expansion plan at our Aurora site in Canada. There are other plans in the works, and as we get to fruition, we will announce those as appropriate. In terms of M&A, I think each of the businesses has targets and ideas that they would like to execute on. In the CDMO business, we're looking for either plants in certain countries so that we can add to our capacities, or capabilities that are adjacent to us that we don't have and that we can then use to add into our integrated BD network. In the complex hospital generics, we're looking for products that go into the hospital or companies that also have products that serve the hospitals. Similarly, in the branded generics or the India consumer health, we would look for OTC brands and portfolios that we can add to our current business. We would also look at going back to the branded generic formulations, provided we can get a sales force that is coherent and brands that are significant in their respective molecules. So as time comes, we will announce acquisitions once we get to the appropriate time.
Thank you. The next question is with respect to the CDMO business. The question is, Piramal is amongst few Indian CDMOs that have facilities in US, Europe, and the capability to provide nearshore manufacturing. Is this facet becoming more important as global supply chains become more uncertain? If so, how does it impact margins and ROE, given costs would be higher on nearshore manufacturing?
So what I will do is share with you a little bit of a snapshot in our order book this year so far. The first thing is that our order book in terms of year-to-date as of today is more robust and higher and of higher quality than we have ever had in our history. if you then unpack that, we actually have very strong orders across all three geographies, and there's a different story to be told against each of them. In the case of North America, there is a desire in the combination of the location and the technologies we're offering. And in the UK, there is an interest in the combination of the technologies and the integrated offerings we provide, particularly with our antibody drug conjugation. And then in India, we've actually had incredibly strong demand as well from companies that are looking for the combination of quality and value that we can offer, sometimes on a standalone basis within India, but other times included in and as part of integrated projects like what John and Stu described. So what we've seen is that it's been a multifaceted, multidimensional growth. And we also see that this growth only helps improve margins in each of our sites, because what it does is it increases revenue, it increases aggregate gross margin, and therefore it obviously flows through to the bottom line in our plants as we see the improvement in margins and return on capital. And the assumption that you would have lower margins in the US and higher margins in India, I would challenge and say that if a customer requires something to be made in a particular geography, and they're comparing amongst and between options in that geography, the pricing also reflects that. And we would see, at least in our CDMO business, that if a customer wants to be able to drive to the plant and they're living in Pennsylvania, they will understand what it costs to make something in that plant, and they will be willing to pay what is required to meet that service. And so we see that we can have profitable, growing, good return on capital with an upward trajectory on those in all of our major geographies. And we actually think by having capabilities in these geographies, we don't force our customers choose between us and another provider. They can choose between which option within our network they want to pick.
Thank you. The next question is with respect to the business mix evolution. The question is, how does management see the business mix evolve in the next 4 to 5 years? And what are the margin and ROCE pecking order for the different segments of the business?
So I think each of the businesses will expand. I think we've established that we have organic growth plans for each of these. I think what will make the difference in this business is the acquisitions, and that will be depending on the opportunity and the price value ratio. In terms of margins, I think we will, as we said before, that in the long term, we will head towards the late 20s. In the consumer healthcare, we may actually decide to reinvest our EBITDA into accelerating growth through media and through investing in e-commerce. But the other two businesses will continue to be margin accretive in the future.
Thanks. The next question is with respect to complex hospital generics business. Is there any update on Displurin launch in the US market or any timelines around that?
Give some background on this. The first thing is that our product is already available in the UK and in South Africa, and the physicians that have used it love it. Our particular container closure system, which is proprietary, is easier to use and has a number of ergonomic and other benefits over the Baxter alternative. And so we continue to get positive customer feedback from that. And we didn't achieve all of what we wanted this year for two reasons outside the US. The first is we didn't yet have all of the vaporizer options from different manufacturers that our customers wanted, and we've now addressed that and expect that to be resolved in the coming fiscal year. And the second one is that because of the COVID-related challenges, it was difficult to have the conversations in the surgery areas because they were not able to have those conversations. So we expect both of those situations to be different, and therefore we expect good ex-US growth as we continue to launch it in additional countries with the obvious increased access and also the additional vaporizer alternatives. In the context of the US, I'd say based on the current US FDA communications that we've had recently, We're currently targeting a CY22 launch for that product.
Thank you. The next question is, are there any plans for re-entry into the domestic formulations market, and what is the tentative timeline, and if there are any identified product portfolios for this?
So we keep looking at acquisition opportunities in the domestic formulations. And as we've said, things that we're looking for are having a coherent and a strong sales force and good brands. And possibly if we can convert those to OTC and align to our existing portfolio, that would be even better. However, I think by nature, these acquisitions are opportunistic. So when the time comes, we'll announce them.
Thank you. Next question is, are there any timelines for listing the financial services and pharmaceutical business separately?
So let me take that. I think you've seen that we have made now many steps. We are moving towards separating the two companies, the two businesses into two distinct companies, financial services and pharma. I think in the midterm, you will see that we will go ahead and do the listing.
Thank you. The next question is with respect to the CDMO business. The question is, do you believe that follow the molecule integrated services with slightly lower ROE due to scale in each service is the path that Piramal Pharma wants to pursue? Or do you believe that concentrating on a few pockets of services and creating scale and cost leadership in those with higher ROE is a better way to go?
So first of all, we obviously respect the competitors that follow some of the strategies described in the, leading question. What we would say is that in looking at industries in general, as we've looked at the progression, at least our perspective is that customer-oriented businesses that focus on customer needs and then address solutions around value in the broadest of sense, we feel will be the most persistent, durable, and resilient over time. And our particular strategy makes us very resilient and important to customers because if you look at them as they want to reduce to fewer partners and get more value from those partners, we are well positioned to do that with our integrated services offering. And it's also much harder for either us or our customer partner to move on to a new relationship because of how embedded we become in them and them in us. And that makes it, we think, a more durable strategy. In addition, the combination of location and capabilities being granular, and we've experienced both of these points the other way in our history, we believe makes us more resilient to shocks or changes or uncertainties that could happen in any particular context so that we don't have single plant risk at the same level of someone who would have a concentrated strategy. We don't have single customer risk the way that someone would have a customer concentration strategy. And so we feel that this particular approach is going to be in the medium to long term much more durable. And with respect to the specific comments around margins and return on capital, I would say that while we're not where we want to be at the end, if you look at us over a decade time horizon, I think we could show that we've shown above market growth rates, we've shown improvement in EBITDA margin percentages, and we've shown improvement in return on capital percentages. And so if you believe in what we've shared with you today about why we're well positioned to succeed, I think you could expect that those trends would continue. And if you also believe our assertions around follow the customer and the learnings from that industry is, I'd rather be providing value across more dimensions than only being focused on cost, because then you get pushed into a commodity bucket. And so that's why we believe in our approach.
Thank you. The next question is with respect to the complex hospital generics business. What is your approach to adding new products to this business? And what are the organic growth rates for the subspaces of injectables, inhalation, and intrathecal therapies?
So I'll cover very briefly, and then Michael can maybe add on, because it was a multi-part question and we may miss parts of it. The first one is in relation to the way in which we go about adding products. There's an art and a science, but there are innumerable possibilities of product geography combinations that we could go after in the hospital area. And so we spend a lot of time with our team and the market understanding which of those we think are the most attractive to go after. And that's our hunting list. And we go after those. In addition, they're obviously inbound. And we look for partners who we think are credible in terms of the development of the products. They think that they're going to be available at the right time, that they have the right quality track record, and that they're going to have the right cost of goods. And through that dance, we find out which ones we want to go after. And then we convince them that we're their best choice. And I think the example Michael gave of DexMed in the US, where we, with our launch, we're going to be the sole provider to the largest GPO in the US, is a credible example of which we have multiple, where we say, if you give us your baby, we will make sure it goes well. And we were able to demonstrate to them that we're their best choice for partner versus alternatives once we picked that this is something we want to have. And so that's the first answer. In terms of the next question about organic growth, I think we covered that a little bit at the end of that section, but we do see growth opportunities for most of our business. And in some categories, we see it maintaining. And I think that we've laid out both for the inhalation and the injectable areas where and how we would obtain that growth. And in the interest of brevity, we can point back to that slide. And if Michael wants to add anything further to either points, please do.
Yes, thanks, Peter. With respect to the rate of growth, I think it's better to focus on the extent of the opportunity for growth in each of our segments within the complex hospital generics business. Obviously, the injectable product portfolio opportunity, adding on products to our platform, offers the highest opportunity for growth. And that is where we are, spending a lot of time in terms of the earlier question about identifying opportunities for acquisition, in licensing, and such. With respect to the inhaled anesthesia growth opportunity, it's there, but it's a smaller total addressable market. We have been growing, and we will continue to grow that business through product extensions, launches into additional territories, and expanding the launch and availability of desflurane. So we are comfortable that those will continue to grow. Intrathecal will grow to a certain degree geographically, but because it's such a niche business, the opportunity for growth, the number of patients who are potentially accessible to this therapy is relatively low. So probably the rate of growth there and the opportunity for growth is lower in that. But I'd say the existing business is probably stickier than some of the potential other particular molecules. So I hope that addressed that.
Thanks, Michael. Next question is with respect to the CDMO business again. The question is, in one of the slides, the peak sales for 3 products is expected to be approximately $5 billion. How much is the opportunity for us at peak sales, and over what period?
So I think the aim of that comment was to describe that we're serving relevant projects for sizable products that are relevant to our customers and relevant to the market. If we were trying to translate all of this comment down into essentially the base question of, well, how do you see this growing? And I would say that overall, we would see the CDMO business should grow faster in the medium term than it has in the past organically. And that we aren't betting on any one product, we're not betting on any one customer. And the underlying driver of the growth, if I were to summarize it very succinctly, is those 19 products that just went commercial are going to grow. And the 30 products that are phase 3, if only half of them go to commercial and then they launch, they're going to grow. And then you continue, that's going to be the inflection point in terms of the outsized growth versus the past period. And continuing our organic actions and everything else, combine those, that's why we think the next 5 years bit of a higher growth than the last 5 years. In terms of specific quantification, I understand why you're asking, but I would encourage you to get into the specific.
Thanks, Peter. The next question is with respect to the consumer healthcare business. Is there any scope to increase the reach within India for the consumer healthcare space? Or is it now time to gain market share in already penetrated cities and towns?
I think we're still a fairly small section of the available market, and we need to gain market share and new consumers in already existing cities. We're in 1,500 towns and cities in India. I think as we go further, they become a bit smaller.
Thanks, Nandini. The next question is around target debt to EBITDA ratio for the pharma business for the next 3 years.
So our current net debt to EBITDA is 2, and with acquisitions, that we think we can take it to 3.5 to 4, and we would bring it down after that.
Just add that there is enough capital that the balance sheet of PEL has to look at the growth opportunities both organically and inorganically. So more than looking at the EBITDA to debt, the debt to EBITDA number, I think it's key to see the potential that the company can create with the capital that it has on its balance sheet, and also for the pharma business where the capital raise recently happened.
Thank you. The next question is, does the management expect to leverage the new product incentive scheme that the government has launched?
Right. We expect the new PLI to come in March, and we'll see what the rules are, and I hope we can actually use it.
Thank you. Next question is the China Plus One strategy that we are hearing these days with respect to APIs visible at your side through inquiries, or is this only buzzword?
For our customers, just as a bit of a background, is that I think almost 2 years ago now, it's been less time, but we actually realized that many of our intermediates and other suppliers in China were having irregular supply to us, and in particular our CDMO customers, because of various reasons, particularly environmental issues. So we went through a conscious strategy to create second and in some cases third suppliers across different companies and countries along with our CDMO customers. And we also did this in our critical care business, where we had an incredibly low reliance at the time of COVID on China vis-a-vis almost all of our Indian listed competitors. And therefore, as a second step, we further looked at it, and we've now even gone to look at what we call customer controlled inputs to further de-risk it, where it used to be the customer would just say, take this, and we'd have to take what it was, where it was. We've actually gone through them and pointed out to our customers certain single source reliance areas. And so from a resilience perspective, the way we see it is that we want to make sure that anything that's critical to our production or our customers and ultimately patients, we would like to have 2 choices in 2 countries from 2 companies so that we can not have that be an issue for our customers and their patients. And sometimes it's China, sometimes it's someone else, and sometimes it's Italy. I think John mentioned an example there. Sometimes they want something different than the UK. And I would just say that in this construct, we actually think it's about resilience is important, and it's not defined always neatly in newspaper headlines, and it's more about making sure that we get what we need and we have backups in case something's not quite right for our customers and their patients.
Thank you. The next question is with respect to price erosion experienced in generic injectables, given that there are limited players in tough regulatory environment. Any observations on that?
I'd say it's less than the other categories, but generally there is price erosion, but it comes down to a molecule by molecule story and a country by country story. And if you were to talk to our portfolio planning analyst, he'd tell you for every molecule in every country, there's a story. And our whole point is that we're not picking the industry in general, which is already more attractive than other categories. We're picking within that ones that we think are more interesting. And so we would just recommend that you look at our overall margin profile in aggregate, and also that you look at our track record and trajectory in the future, that we're going to be better than many in picking the right ones, and we'll get it more right than wrong. I don't know if Michael wants to add anything further to that.
The only thing I'd like to add is it's very important to have the right mix of products and to also be very efficient in how we execute the business, which leads to better profitability. And I think that, as Peter said, our track record should speak for itself in that regard. But it's not all about. We want to be able to compete effectively in the market, and if we are, the profitability will follow.
Thanks, Michael. Last two questions. First is, what is the effective tax rate of the business and average cost of borrowing for the pharma business?
Most of the debt that we carry on our balance sheet is located outside of India. So the average cost of borrowing is about 4 to 5%. And the effective tax rate is between 24 to 25%, given the fact that large sections of our business is either in India or in US, and there the tax rate is about 25%.
Thank you. And the last question for this evening, how is the CDMO business different from peers such as Bushy and Syngene? Are we also providing support to innovators in the business?
I would, without attempting to repeat, I will say that we believe that we offer across the entire life cycle, we offer substance and product. We have equally balanced capabilities across Asia, Europe, and US. We have patient centricity, we have customer centricity, we have an impeccable quality track record, and we have great experience in providing integrated services to customers. And I guess the final question on differentiation is that customers have choices on where to place projects, and ultimately we think that we're winning more than we're losing, with the win rate above 50% over a longer, a reasonable period of time. And I guess that may be the proof.
Thank you. With that, we come to an end. Thank you everyone for participating, and a big thank you for the management team to participate in this meeting.
Thank you.
Have a good evening and a good weekend.
Thank you very much.
Thank you.
Thank you.